Welcome to Talk Tickers. We're the ones who cut through all the noise of earnings calls to give you the insights that, well, really matter.
That's the plan.
Today, we're diving deep into the Travelers Company's first quarter 2025 earnings call. The short version, pretty strong profit, even with some major headwinds.
Yeah, that's right. I mean, they were facing, $1.7 billion in pre-tax catastrophe losses, mostly from those California wildfires back in January.
Oof, yeah. $1.7 billion.
But even with that, they managed a core income of $443 million. That works out to $1.91 per diluted share.
Okay, so how did they pull that off? Must have been strong underlying performance.
Exactly. That plus some favorable prior year reserve development, we can get into that, and higher income from their investments. Those three things really offset the catastrophe losses.
Got it. And the return on equity, that's always a key one.
Came in healthy. The trailing 12-month core ROE was 14.5%.
14.5%. Okay, solid.
And the underlying profitability, just looking at the insurance operations before taxes, was, impressive. Pre-tax underlying underwriting income jumped to $1.6 billion.
$1.6 billion. How does that compare year over year?
That's up over 30%, a really significant increase.
Wow.
And it was driven by, strong earned premiums, about $10.7 billion, and a much better underlying combined ratio.
Right. The combined ratio lower is better there. Where does that land?
It improved to an excellent 84.8% overall. And all three of their main segments contributed positively to that underlying number.
84.8 is pretty great for insurance. And premiums written. Did they grow the top line too?
Yep. Net written premiums came in at $10.5 billion for the quarter.
Okay. Anything else jump out from the summary?
Well, one more thing worth noting up front. They bumped the quarterly dividend again, a 5% increase to $1.10 per share.
And that's a long streak for them, isn't it?
It is. Marks the 21st consecutive year. They've increased the dividend, speaks volumes about their confidence and financial stability.
Definitely sends a signal. Okay, let's dig deeper. That $1.7 billion catastrophe loss figure from the wildfires, that's huge. How much cash actually went out the door?
Good question. So while the pre-tax loss was $1.7 billion, they've already paid out nearly $750 million. That includes some pretty substantial advance payments to get money to policyholders quickly.
Okay, $750 million paid out. Did that strain their cash flow much?
You might think so, but their operating cash flow for the quarter actually remained quite strong, came in at $1.4 billion.
$1.4 billion, even after paying out almost $750 million on those claims.
Exactly. It really highlights, the strength of their ongoing premium collections and just their overall financial management. They seem to handle liquidity well, even with these big hits.
That's resilience. All right, let's break down the underlying performance by segment, starting with business insurance. How did they do?
Business insurance looked pretty good. Their underlying combined ratio improved nicely to 88.2%.
88.2, okay. And premiums?
Net written premiums hit a record $5.7 billion. That's up 2% year over year. Now, you do have to factor in the impact of an enhanced casualty reinsurance program they put in place.
Reinsurance. So insurance for the insurer. That probably helps manage volatility.
Precisely. It protects them against those really large losses. But even accounting for that, they saw strong renewal premium changes across most lines in BI, and retention actually ticked up to 86%.
Better retention, good sign. New business.
Also strong, a record $735 million in new business for the quarter.
Okay, so business insurance seems to be, firing on all cylinders. What about bond and specialty insurance? That's usually a pretty profitable segment for them.
It was again this quarter. Very strong results. The underlying combined ratio there was an excellent 87.3%.
87.3, even better. Premium growth.
Solid. Net written premiums grew 6%, hitting $1 billion. They highlighted excellent retention in management liability.
Okay.
And really strong growth in their surety business. They linked that to a, quote, robust construction environment.
Surety. Right. Guaranteeing contracts. So lots of construction activity driving that.
That's the picture they painted. Seems like healthy sector for them right now.
Makes sense. Now, personal insurance. I guess that's where the wildfire impact really showed up on the bottom line.
Yes, absolutely. The segment reported an overall loss for the quarter because of those huge wildfire claims.
But what about the underlying performance, stripping out the catastrophe?
Actually, quite strong there too. The underlying combined ratio improved significantly, came in at a terrific 79.9%.
Wow, under 80. That's really good for personal lines.
It is. And net written premiums grew by 5% to $3.8 billion. That growth was mainly driven by strong renewal premium changes, especially in homeowners insurance.
So they're getting the pricing they need in homeowners, it seems.
It suggests their core pricing and risk selection are working well, even if a massive event like the wildfires hits the reported results hard for the quarter.
Okay, so underlying profitability looks solid across the board, even with that personal insurance headline loss. Let's talk expenses. Did they keep costs in check?
They did. The overall expense ratio improved down to 28.3%.
Lower than last year.
Yep. And importantly, they said they're comfortable with a full year expectation of around 28% to 28.5%.
Even with inflation and maybe investing more in tech.
Exactly. Even with planned increases in strategic technology spending, it suggests they're finding efficiencies elsewhere or getting good operating leverage.
You mentioned favorable prior year reserve development earlier. Can you unpack that a bit? Sounds like good news.
It is good news for the current quarter's results. They reported net favorable prior year reserve development of $378 million before tax.
And what does that mean exactly?
It means that the claims from previous years turned out to be less costly than they had originally estimated and set aside reserves for. So they're releasing some of those prior reserves, which boosts current profit.
Suggest their initial estimates were maybe a bit conservative, or things just turned out better?
Could be a mix of both. It suggests their reserving process is pretty solid. And this favorability came from all three segments.
Which areas specifically?
They mentioned workers' compensation and business insurance, management liability and surety within bond and specialty, and also auto and home within personal insurance.
Interesting. Okay, turning to the investment side, how did that contribute?
Investment income was a positive story, too. After tax, net investment income rose 9% to $763 million.
$763 million. What drove that increase?
Mostly strong returns from their fixed income portfolio. Higher interest rates are helping there. Plus, they have more assets invested. They also got positive returns from their alternative investments in Q1.
What's the outlook for investment income?
They expect the fixed income NII to keep growing through the year. They're projecting it could reach about $790 million in the fourth quarter.
Sounds good. Any caveats?
One, they did caution that the financial market declines we saw near the end of Q1, well, those will likely hit their alternative investment results in Q2. There's a reporting lag there.
Oh, okay. So fixed income steady, but maybe some lumpiness in alternatives next quarter.
Got it. Let's talk capital management. They returned cash to shareholders. They did. Nearly $600 million of excess capital went back to shareholders in Q1.
How was that split?
About $358 million was through share repurchases. And then, as we mentioned, the increased dividend accounts for the rest.
And share buybacks usually help boost the share price and earnings per share over time.
Correct. Plus, their adjusted book value per share, which is a key metric of shareholder value, was up 11% compared to last year.
And do they have more capacity for buybacks?
Seems so. They mentioned having $4.8 billion still remaining under previous board authorizations, so plenty of firepower left if they choose to use it.
It sounds like they're feeling pretty confident overall. What did they say about the broader economy, the macroeconomic outlook?
They definitely projected confidence. They acknowledged the environment is uncertain, but highlighted their strengths. The diversified business mix, those strong underlying margins we talked about, resilient cash flow, a well-managed investment portfolio, and just a strong balance sheet overall.
So they feel well-positioned to handle whatever comes.
That was the message. They believe those factors put them in a good spot to navigate potential economic bumps in the road.
Okay. What about external factors? We hear a lot about tariffs these days. Did that come up?
Yes, they touched on it briefly. They view the direct impact of current tariffs as manageable.
Manageable. Where would they feel it most?
The main area they flagged was potentially physical damage repair costs and personal auto insurance. They said maybe a mid-single-digit one-time increase in severity could happen.
One-time hit, but maybe not even that bad.
Right. They also mentioned potential mitigation through their supply chain and pointed to their existing profit margins in auto as a buffer. So maybe not a huge impact in the end.
Gotcha. You also mentioned increased tech spending earlier. What's the strategy there? Just keeping up? Or something more?
It sounds more strategic. They said strategic tech spending is becoming a larger percentage of their total tech budget.
Investing in the future, basically.
Exactly. Supporting new initiatives, ongoing projects, all aimed at boosting efficiency and staying competitive. And they stressed they plan to do this while still aiming for that overall expense ratio to decline through operating leverage.
Interesting balancing act. What about the cost of claims itself? Loss cost trends. Were those behaving as expected?
They said loss trends in the quarter were pretty much in line with what they anticipated.
And that supports the margin improvement we saw.
Yes, it supports the idea that the pricing increases they've achieved are actually earning through and benefiting margins. They did specifically note that prior year development in auto was favorable.
Favorable auto development, why was that?
Came down to both frequency and severity of claims being better, meaning lower than they had initially projected for those prior periods.
Okay. And we talked about surety growth.
Yeah.
What's driving that continued strength? Just the construction boom?
Seems to be the main driver, that robust construction environment and continued demand. They did emphasize their focus on high credit quality contractors, though.
So, selective growth. Are they watching things like infrastructure spending bills?
Definitely. They mentioned government infrastructure spending as a factor they're monitoring, which could obviously provide another tailwind for surety down the line.
Makes sense. Let's circle back to personal insurance quickly. Apart from raising rates, are they taking other actions to shore things up, especially given the catastrophe risks?
Yes, they outline a few things. Trying to improve the underlying fundamentals in both auto and home.
Like what?
Well, for homeowners, ensuring that insured values, the coverage amount, keeps pace with rising replacement costs, that's crucial to avoid underinsurance.
Good point. Costs to rebuild have shot up.
Exactly. And also strategically managing their exposures in high catastrophe risk areas probably means being more selective about writing new business in certain zones.
Pulling back a bit in risky areas.
Potentially, or just being much more careful about the risks they take on there. They also noted that new model and auto policies, just auto, no home bundled, are mostly being written on a 6-month basis now.
6-month policies. Gives them faster repricing ability.
That's the idea. More frequent opportunities to adjust rates if needed. One last point on workers' comp. They noted pricing continues to be down slightly, which is a headwind for premium growth.
But claims costs.
Medical claims inflation has actually been pretty benign lately, but they are maintaining a cautious long-term view in their assumptions there, not getting complacent.
Okay, quite a lot to unpack there. So if we were to summarize this whole deep dive on Travelers,
Yeah.
despite a really significant hit from the California wildfires, the underlying business looks, well, pretty strong.
I think that's fair.
Yeah.
Strong underlying profitability across the board, good expense control, decent investment results, favorable reserve development this quarter, and they're continuing to send cash back to shareholders.
And they seem pretty confident about handling economic uncertainty. Highlights the resilience of their model, maybe.
Yeah, I'd say so. Their ability to navigate the huge catastrophe loss while still posting solid core results and showing strength in BI and bond and specialty really speaks to the diversification and underwriting discipline. Plus, the focus on tech investment alongside cost control suggests they're playing both offense and defense.
Right. Okay, that brings us to our, this is not financial advice segment. Time for some slightly more speculative thinking based on what we heard.
The outrageous but plausible trade ideas, always fun.
All right, idea number 1. Considering Travelers' strong capital, their history of buybacks, and just their general resilience, but also acknowledging that, markets get jittery about the economy or unforeseen events.
Okay, where are you going with this?
What about selling some out-of-the-money put options on Travelers stock, say below the current price, maybe a few months out?
Interesting. So the thinking is you collect the premium if the stock stays stable or goes up. But if there's a dip, maybe due to macro fears, you get assigned the shares.
But at a price you decided was attractive beforehand. Leveraging their proven resilience and commitment to shareholder returns for a potential entry point or just income generation.
It's definitely playing on their perceived strength and stability. Of course, disclaimer, this is absolutely not financial advice. Selling puts involves significant risk, including the potential obligation to buy stock at a price higher than the market price if it falls sharply. This is purely hypothetical.
Absolutely hypothetical. Okay.
Yeah.
Outrageous idea number 2. We heard about the really strong surety results driven by construction.
Yeah, that robust construction environment and maybe future infrastructure spending.
So what if you took a long position in, say, a construction material supplier, one that's heavily geared towards those big infrastructure type projects?
Okay, riding the coattails of the surety signal.
Exactly. But maybe hedge it slightly. Perhaps short a broader market ETF to mitigate some general economic downturn risk. The idea is that Travelers' surety strength is a specific signal about that kind of construction, which might outperform the broader economy.
That's a more complex pairs trade, trying to isolate that specific sector strength indicated by travelers' results. Again, lots of moving parts there. And the same disclaimer applies. Not financial advice. Hypothetical idea only. Significant risk of loss involved in long-short strategies and sector bets.
Definitely not advice, just kicking around ideas based on the call. Remember, everyone, all this analysis comes straight from the traveler's earnings call information. You absolutely need to do your own homework, consider your own situation before making any decisions.
Couldn't agree more. Think about what stood out to you from this call. What were your key takeaways? We'd be interested to know.
Well, that wraps up our deep dive into the Travelers Company's Q1 2025 earnings. Thanks for tuning in to Talk Tickers. Join us next time when we'll tear into another key earnings report.